You think the economy is getting better, but the truth is you are actually getting poorer every single day because you are playing a game where the rules were written by people who want your lunch money. Look at the data right now and tell me if this feels normal to you. The cost of living is skyrocketing, interest rates are eating your soul, and while you are debating which fast food meal is still affordable, the greatest investors in history are quietly exiting the building. 20% of the world oil flows through a waterway narrower than the drive you make to the grocery store, and right now that waterway is a war zone. Brent crude just ripped into the triple digits per barrel. Tankers are being seized while blockades are being reimposed. Before we dive into the bloodbath, I want you to do one thing for me right now. Stop what you are doing and comment your age and the exact amount you are currently investing every single month down in the comments below. Are you doing $50 a month or $5,000 a month? Be honest, because we are building a community of winners here, and transparency is the first step to escaping the rat race. If you do not have a plan, you are the plan for someone else to get rich. Let that sink in. You are going to hate me after what I am about to tell you. But if you have less than a certain amount invested, compounding sucks, and you are probably below it. You think compounding is always working for you, but it is not. For years, maybe decades, it is barely doing anything. Everyone says trust the process, but what they skip is the part where your portfolio sits completely flat for what feels like forever, and you start wondering if you are doing something wrong. You are not doing anything wrong. You just haven't hit the number yet. And once you do, everything changes. There is a specific dollar amount sitting inside the compounding curve, a threshold, and once your portfolio crosses it, the math shifts in a way that most investors never fully understand until they are already on the other side of it. Before that number, you are the engine. Your paycheck, your discipline, your sacrifice is what is moving the needle. After that number, something else takes over, and for the first time in your investing life, your money starts doing more work than you do. In this video, I am going to show you exactly what that number is and how to get there in the fastest possible way. So make sure to stay until the end if you want to have a step-by-step strategy. Today, we are talking about why the legends are selling and why you are likely buying their bags at the top. We are seeing the highest cash levels in history at Berkshire Hathaway, over $397 billion just sitting there waiting as of May 2026. This is not a coincidence, this is a signal. But before you panic and sell everything, you need to understand the difference between a billionaire and a regular person. You have an advantage that they hate, and that advantage is your size and your ability to be nimble while they are stuck moving like giant oil tankers in a bathtub. Let us look at the reality of the market right now using the Buffett indicator, which compares the total stock market value to the GDP of the country. Historically, when this hits 100%, we start getting nervous. When it hits 150%, it is a red alert. Right now, we are sitting over 230%. We are not just in a bubble, we are in a bubble inside a furnace, and yet the average person is still chasing the latest tech hype or some random coin they heard about on a bus. The secret to wealth is not being a genius. It is having the discipline to stay a long-term investor while everyone else is acting like a crack addict in a casino. The S&P 500 has delivered an average annual return of around 10.6% since 1957, including dividends. That number is real. Over the last 30 years through 2025, the average annual return has been around 11.8%. But the issue is what 10% actually means when applied to a small portfolio. Because when your portfolio is small, 10% of a small number is still a small number. If you have $20,000 invested and the market returns 10%. You made $2,000, that is nice, but you probably contributed more than that in a single month. Your savings rate is still outrunning your returns by a wide margin. At $100,000, 10% gives you $10,000. Now we are getting somewhere, but here is where it shifts. At $200,000, a 10% return gives you $20,000 in a single year. That is more than most people invest annually. The market just outworked the median American household savings rate, which sits below $20,000 per year. And then you hit at the real threshold, the number where everything accelerates, $300,000. At $300,000, a 10% annual return gives you $30,000. That is the equivalent of a massive raise that you did not have to earn, negotiate, or trade hours for. This is the inflection point. But I need to tell you the part that nobody puts in the highlight reel, because this is where most investors quietly destroy years of progress. Reaching $300,000 feels like an achievement, but psychologically it creates a trap. After years of discipline, you finally feel like you have earned the right to breathe. But the years immediately after $300,000 are the most powerful compounding years you will ever experience. The curve is bending, and the cost of interrupting it right now is higher than it has ever been. Say you have hit $300,000 and the market drops 25%. It looks like years of work evaporating, so you move to cash. But missing even the 10 best days in the market over a 20-year period can cut your total return nearly in half. According to a JP Morgan study, an investor who stayed fully invested earned an average annual return of nearly 10%, while missing just the 10 best days dropped that return to around 5%. Those 10 best days often happen during or immediately after the worst stretches of the market. If you are sitting in cash waiting for things to feel safe, you miss them. The second trap is lifestyle inflation. You have been disciplined for years and now you have $300,000. So you upgrade the car for $45,000. You tell yourself you earned it, but $45,000 removed from a portfolio at $300,000 left alone for 20 years at a 10% return would have become roughly $300,000. You did not just buy a car, you spent $300,000 of future wealth on a piece of metal that will be worth zero in a decade. This is not about living like you are broke forever. It is about understanding the real cost of pulling capital out at this stage. You are not pulling out money, you are pulling out momentum. The people who build 8-figure portfolios are not people who out-earned everyone else. They are people who understood that once the engine starts running, you protect it. You keep driving the 2006 Toyota Corolla, you keep living in the minimalist apartment, you keep your DCA active in VU and VTI. Now let us talk about the 3 Cs of when to sell, because you need a framework for when oil hits $140 and the world feels like it is ending. C number 1 is a change in the company. If the business has changed for the worse, like a new competitor or management making bad decisions, you leave. C number 2 is cost. When a stock like Apple is no longer a bargain and is trading at 30 times earnings, it might be time to take profits. C number 3 is a change in cash needs. If you find a better opportunity and need cash to buy it, you sell. But Buffett does not sell just to sit on cash. He sells because he believes he can use that cash for a better return later. If you are tired of letting CNBC headlines dictate your stress level, you need to own businesses with 3 specific traits. Trait number 1 is a fortress balance sheet. You want piles of cash and debt that is small relative to free cash flow. If revenue drops 30% tomorrow, would the business survive or call a bankruptcy lawyer? Trait number 2 is a moat. Pricing power is the gold standard in an inflationary environment. If Coca-Cola raises prices and you still buy the can, that is a moat. Trait number 3 is management you trust to allocate capital during a crisis. We are entering a period of massive volatility. We have over $40 trillion in national debt, and geopolitics is a powder keg. The only way to shield yourself is to own productive assets. Stop watching the charts every 5 minutes and start looking at your savings rate. That is the only metric that truly matters for your freedom. Most of you will quit in year 3 because the market went sideways and you wanted a new iPhone. Do not be that person. Be the person who understands that the market is a tool to build freedom, not a video game for dopamine hits. The wealth gap is widening and you have to decide which side you want to be on, the side that pays interest or the side that collects it. If you start with $0 and invest $1,000 a month into a broad market index fund, returning 10% annually in 30 years, you have $2.2 million. The path is not a straight line. It is a jagged, messy journey that tests your character. But when you reach the other side, you will realize the money was just a byproduct of the person you became. You became someone who could delay gratification and ignore the noise. Stay disciplined, stay focused, and keep your head in the game. The 2026 market might be a roller coaster, but you are holding the controls. Do not let go. The future belongs to those who prepare for it today. If you found value in this, hit that like button and subscribe, because we navigate this storm together every week. No fluff, just the raw data you need to survive. Watch this video on screen to understand which strategy you should use in a crash. Hit that subscribe button. Peace.